Okay, let's get going. I'm Ron Mueller. I'm the author of Home Business Tax Savings Made Easy. If you've got an older version of my book, it's called "It's How Much You Keep That Counts, Not How Much You Make." The book was retitled when the 5th edition came out just a couple of weeks ago. It's the same book, same content. Just the 5th edition has a new name, easier name to remember, I hope, and also updated information, updated as of about a month ago. So it's very, very current. 5th edition of the book. So let's launch into this call. I'm told I heard a sentence pronounced 3 different ways that I think is significant, and that's everyone needs a home-based business, everyone needs a home-based business, and everyone needs a home-based business. Now, why would that be? Well, if everyone needs a home-based business, why is that true? In times of economic turmoil like this, I've heard it called economic confusion. We need a home-based business for at least 2 reasons. One is we all need another stream of income. Because I don't know anybody who has a W-2 job that's anticipating getting a pay raise or a bonus or a promotion this year. So just to stay up with the increased cost of living, we're going to have another stream of income of some kind. But the most important reason why we need a home-based business is a backup plan. Nobody really knows who has job security. We all think we have job security, and none of us really know. The only people who really have job security are the ones that are self-employed, and they don't have job security either. It's just they have nobody to complain to if they lose their job. So the backup plan is to have something you can do instead of looking up the address of the unemployment office. If you go to work tomorrow and find out you don't have a job for whatever reason, your company, your department was right size, upside, downside, capsized, whatever it was, you could come home and look up the address of the unemployment office and polish up your resume, but Congress would rather you activate your backup plan. That's turn a part-time home-based business into full-time, and that's the primary reason for these tax breaks. So if you agree with me that everybody needs a home-based business and need one right now, then why isn't everybody jumping into a home-based business right now? Well, we've got a couple of little challenges that we're dealing with. One is that half the people just don't have any money. And the other half, well, they're afraid to spend the money they do have because the media is afraid that things are going to get worse. So we've got to be prepared in case things get worse. So half the people have no money. The other half won't spend the money they've got because they're afraid that things are going to get worse. So the irony is that because of those 2 little challenges, the very time when everybody needs a home-based business the most, that's also the time that they can least afford to get one going. So what do we do? We'll consider this. What if there's a third option? And there is a third option. It's called OPM, called other people's money. That's a business term, but in our case, other people's money might be the other Uncle Sam. If we've got broke people that don't have any money and scared people that won't spend the money they have, what about informed people who will let Uncle Sam pay for it? I'll talk about on this webinar tonight. How's that work? Well, if Congress has said that to qualify for a home-based business, there are only 3 requirements we have to meet. If we do those 3 things, we meet all the home business tax breaks that they've authorized, and we're going to talk about what some of those are on this call. At least 3 to 4 hours a week of working. What they actually said was work your business on a regular and consistent basis. Regular and consistent basis. So that's not 3 or 4 hours a week randomly sometime when you can fit it in during each week. But it's some kind of a schedule. It doesn't have to be rigid, because that's part of the fun of having a home-based business is the flexibility. But it ought to be relatively stable. So you've got like maybe three days a week you work your business an hour, or 6 days a week you work your business a half an hour, something like that. So regular and consistent basis, 3 to 4 hours a week minimum, with a profit intent. The key word there is intent. You do not need to make a profit before you qualify for these tax breaks. Congress wanted to make sure you qualify the minute you get into business. So even before you can spell the company you've just started, you can qualify for the tax breaks. So 3 to 4 hours a week with a profit intent. And there is no minimum, by the way. Let me dispel a rumor. There's no minimum or maximum as to how long you can claim a loss before you have to be in profit mode. As long as you can continue to show that you're moving towards a profit, you're intending to make a profit. And the last one is simply keep good records. Do things like have a separate checking account so you don't commingle your funds, and maybe get a separate credit card or debit card. Just to keep good records of your income, expenses, and activities. So if we do those 3 things, Home business tax deductions will increase the tax refund of most people by at least $3,500 to $6,000 a year. That's a lot of money. Now, just look at the math. If you take that range, $3,500 to $6,000, that's not scientific, by the way, but I've been doing this coaching for about 10 years, and of the people that I've talked to, I don't know anybody who has saved less than $3,500 in taxes. And I know a lot of people save way over $6,000. And by the way, I don't mean tax deductions here. We're talking tax reduction, like tax refunds. It's dollars that's back in your pocket. $3,500 to $6,000 back in your pocket. If you look at the average of those two numbers, divide that by 12, interestingly, it comes out to $400 a month. So as a home-based business owner, you can have $400 less withheld from your monthly salary for taxes. So if $400 a month less is withheld for taxes, the question is, where's that $400 go? Well, where do you think? It's going to go into your take-home pay, of course. That's the logical place for it to go. So here's the question now: is $400 a month? If that much less being taken out of your take-home pay, is that enough extra cash to run a home-based business? For most people, the answer is absolutely yes. The cost of running a business is way less than $400 a month for most people. So what's that mean? It means Uncle Sam is paying for the cost of starting and running your home-based business. So let's look back at option one. Option one says if anyone can get Uncle Sam to pay for the cost of starting and running their home-based business, and now you know how. Did you see, when you qualify for tax breaks that are equal to about $3,500 to $6,000 a year, and that works out to about $400 a month, Congress passed these tax breaks. They told the IRS to not make taxpayers wait till April 15th to get their refund. So you have a choice. You can wait until April 15th and get a refund of an extra $5,000 or $6,000 or more, in addition to the refund you would have already gotten anyway. Or you can take that refund during the course of the entire year by having your paychecks increased. So you can take the number of paychecks you get a year. Let's say you get paid twice a month. That's 24 times a year. You take the amount of money you're saving in taxes, divide by 24, and that's how much your take-home pay can increase every single payday for the entire year. So Uncle Sam not only can pay for the cost of running your home-based business and starting it, but you get the money as you need it. You get it on a monthly basis. You don't need to wait till the end of the year to get that money. So now anyone can have a home-based business, even if you're broke and even if you're afraid to use your savings. So how about risk? Is there any risk? Well, not really, because congressional law states there's only 3 requirements to qualify for all the home business tax breaks they passed. And those are the 3 we just went over. It's you want to have the intent to make a profit, work your business 3 or 4 hours minimum per week, and keep good records. Do those 3 things, and they say you qualify for the tax breaks. Well, what kind of tax breaks do you qualify for? This is where most people get derailed, because we've all heard that we get a lot of tax breaks when we have a home-based business. But usually that's all we're told. Nobody answers the 3 critical questions. What are those tax breaks? What's it take to qualify for them? What kind of record do you keep? So let's look at some examples. The first example I'd like to talk with you about is business use of your home, because that is a huge deduction that has had some 3 major changes this past year that make this tax deduction even better. If you've ever had a tax pro tell you that you don't qualify for home office, that may have been true in the past. But about a year and a half ago, a law was changed that was made retroactive to 3 years ago. So as of 2006, the definition of who qualifies for home office has changed. The law used to say you qualified for home office if the primary value of your business was delivered from your home. So let's say you're in a network marketing business. Probably 80-85% of the people on these conference calls and webinars are in network marketing. So you'll understand that you've only got 2 things to do in network marketing. You're going to recruit customers, and you're going to recruit distributors. Unless you did that in your home primarily, you didn't qualify for home office. Well, guess what? Congress changed that. When they found out that's how the IRS was interpreting that law, they changed it. So now it says if the primary administration or management of your business takes place in the home, you qualify for home office. Primary administration or management. Administration of things like being on conference calls like this, filling out deposit slips for the money that you make in your home-based business, and developing the list of people you're going to talk to, and scheduling your day, the next day or the next week for business success. Those are administrative and management functions. So virtually everybody now qualifies for home office if you have a home-based business. And in fact, if you don't take a home office deduction, in a few minutes we're going to talk about vehicle deductions. You don't qualify for most vehicle deductions without a home office, because without a home office you have not designated your home as your primary place of business. So when you leave your home, you're leaving your home. You're not leaving an office. So you want to qualify for a home office, and we'll come back to the value of that in a second. The space requirements has changed. The tax code used to say that a home office had to have at least 3 walls around it. At least 3 walls around it? I guess that's the IRS's attempt at humor or creativity, because essentially I guess that means it needs to be a separate room. So Congress changed that one too. Last year they changed that, again, retroactive to 3 years ago. They always go, a lot of times when they change a tax law, they make it 3 years retroactive. That's because you have the right to change your tax returns for up to 3 years. You can file amended returns for up to 3 years back, and so if they make the change retroactive, then you can go back and file an amended return and take advantage of these tax breaks. So here's what it says now. It doesn't say 3 walls around it. Now the tax code says it's still kind of obtuse, but it says a home office has to be a visually identifiable space. So that's still, kind of, what's that mean in English? In English, it means it's got to look like an office. You could literally take a 1-room efficiency apartment, and in the corner of that 1 room, you could put a table with a computer and a printer and a telephone on it, and put a chair up against it, and that kind of looks like an office, doesn't it? Does that look like a desk, look like an office? Well, that's a visually identifiable space. So you can't claim the entire room, but you can claim the space that's occupied by that table and that chair and that little office in the corner of a room of your 1-room apartment. The other thing that was changed was that this always was good, but now it's gotten even better. If you cannot use the deductions from a home office this year, you can roll them forward for use in any future year for the rest of the taxpayer's life. Did you get that? If you had, say, $8,000 worth of tax deductions from your business use of the home, and you only need to have $4,000 to bring your taxable income down to 0 for your home-based business, what happens to the other $4,000? You don't lose it, like other kinds of tax deductions. This one you can roll forward for use in any future year. This is like having a savings account of tax deductions that you can withdraw from at any point in the future when you need it. So there's a limitation and opportunity with the home office deduction. This category is the only category of tax deductions that are available for home business people that has a restriction that says you can only apply the deductions against your home-based business income. All the other tax breaks we're going to talk about, you can apply those tax breaks against any source of income, including your W-2 income, investment property income, investment and interest and dividend income, all sources of income. This one particular category, business use of the home, can only be applied against the income from the home-based business. But if you don't need them all, you roll them forward for use in the future year. This one's worth $2,000 to $5,000 for most people, because here's what the value of it is. How do you get cash value out of having an office in your home? Well, this is called an indirect expense. It's indirect because you're going to have the same rent bill or mortgage bill or heating and air conditioning bills and what have you, whether you have an office in your home or not. So the office in the home is indirectly related to your expenses. But because it's indirectly related, you can deduct a portion of it. So let's say you've got a 1,000 square foot home and you have a 100 square foot home office. You've now got a 10% business use percentage. That lets you now take 10% of the rent or mortgage insurance that you pay. Even rent, by the way, this is the first and only area I'm aware of in the tax code where renters get a tax break. But you do get a tax break if you're a renter. How much tax break depends on business use of your home. If it's 10%, then 10% of your rent is deductible as a business expense. If it's 23%, then 23% of your rent is deductible. Now, you can also write off a percentage, business use percentage of all your utilities. That's gas, electric, water, sewer, trash collection, recycling fees. All those kinds of things are deductible they're deductible in accordance with the business use percentage of your home. Now, this is the percentage of the home that's being used regularly and exclusively for business. So make sure this is an area you don't have to use for anything else. If you ever were to admit in an audit that you ever used that space for anything other than your business, you could lose the deduction. In fact, you probably will, because it's called an exclusive use area. You can also write off 10% or whatever your business use percentage is of your repairs and maintenance expenses, general overhead expenses, things like renter's insurance or homeowner's insurance. All those things are partially deductible. How does that put money in your pocket? Let me emphasize this to you. There are two tax systems in America. If you as an employee got a $100 bill from the electric company, well, first you'd look at that and say, where's the rest of my bill? Because nobody ever gets a $100 bill from the electric company. It's always way more than that, right? So if you got a $100 bill from the electric company, you'd have to go to work to your W-2 job and earn about $160 to $170 in order to pay that $100 bill with take-home pay. If you earn $160 in wages, by the time Uncle Sam takes his bite out of it, you get $100 to bring home to pay that bill. Because a wage earner, an employee, has a three-step tax system that works like this. Step one, you work real hard to earn a decent wage. Step two, Uncle Sam takes a big bite out of that wage before you even get to see it. And step three, you get to live on the leftovers, called your take-home pay. But now let's look at a business owner, and you can be in both categories. If you have a home-based business and you also have a W-2 job, you're in both categories. So your wages are subject to the three-step tax system I just went through. But what about the business owner's income? A business owner has a very different three-step tax system. Step one is they work hard to bring revenue into the business. So far, that's kind of like the employee, right? They work hard to bring money in. But step two is they use as much of that money as they have to pay their business bills. Then step three is they pay taxes on what's left. That's a very different system. What would it be like if on payday you got to bring home all of your wages? No withholdings at all. Bring home all your wages. Then you break out your household budget and you pay your monthly bills. And then you pay taxes on what's left after you paid your bills. You'd pay a lot less in taxes, wouldn't you? You bet you would. Well, that's why businesses pay less in taxes. So if you've got to earn $160 to pay a $100 bill for an electric company, and a business only has to earn $100, then literally for every $100 I can help you convert from personal expense into business expense, I save you about $60. And usually we can transfer between $2,000 and $5,000 easily of personal expenses into business expenses. So by having an office in your home, and by the way, this goes much deeper than I can't go into on this webinar, but it's the form you fill out is called business use of your home. It's not home office, because there can be other areas of your home that are used exclusively for business as well, not just the home office. So there are ways of getting your percentage up relatively high. So this is a significant deduction. The next category I'd like to talk about is business use of your personal vehicles. This category tends to be one of the largest, if not the largest, categories of all the tax deductions for home business owners. The value of the deduction is substantial. You have two ways you can determine the value of your tax deduction for using your personal vehicle for business. The first is using the standard method rate, or actually it should be standard rate method. The acronym is wrong there. Standard rate method is 55 cents a mile. 55 cents per mile for business use of your vehicle. Now that doesn't sound like much money, a couple of quarters a nickel. Okay, here's how you can get in touch with how valuable this deduction is. If you think this isn't worth keeping records for, take a stack of dollar bills and put them on a passenger seat of your car next time you get in, unless you have a passenger there. Then just put them in his or her lap, and push that button on your dashboard that sets your trip recorder to 0, and start driving. When you see that you've driven 2 miles, you see that trip recorder trip over to 1 and 2. Now you've driven 2 miles. Roll down your driver's side window and take one of those dollar bills off the passenger seat, and then throw it out your driver's side window and watch it blow away in the rearview mirror. You drive another 2 miles. You see now your trip recorder says 4. Take another dollar bill off your passenger seat and throw it out your driver's side window, and watch that one blow away in the rearview mirror. Do that every 2 miles for as long as you can stand it until you realize you're literally throwing away about $1 in tax deductions for every 2 miles you drive. If you put 10,000 miles on your car for business purposes, you've got a $5,500 tax deduction. Just by using the standard rate method, you can usually save even more money, have an even bigger deduction if you take a percentage of your vehicle operating costs. Now, what's business use? Well, business use is not only going to and from business meetings and visiting clients and prospects and customers and what have you, but it also can include errands, personal errands, if you combine them with business errands. If you've got to go to the shopping center to buy a birthday present for Aunt Susie, you also need to go to the shopping center to have flyers made for next week's meeting. If you do those as 2 separate trips, one of them is going to be business tax deductible business trip, and one's not. So your average business use percentage of your vehicle will be 50%. But let's say you combine both those trips into one. You go to the same shopping center, you have your flyers made, and you buy the birthday present for Aunt Susie. Was that a personal trip or a business trip? Well, the tax courts have said the taxpayer determines whether it's personal or business. So you can decide if you want the deduction or not. Combine those two into one. If you can decide that you're going to whenever you run an errand, you're going to pause for a second and ask yourself, is there a business errand I can run at the same time? Or you're going to run a business errand and pause for a second and say, is there a personal errand I can run at the same time? You can sometimes combine trips that would have otherwise been separate trips, and you get a tax deduction for the mileage. So you get mileage deduction for that as well. Under some circumstances, you can even convert your commuting miles into business miles. Commuting is defined by the IRS as travel between a taxpayer's home and their principal place of business, and that's non-deductible personal mileage. However, there's a section of the tax code called the two-business location rule that says travel between one business location and another business location is deductible as business miles. So if you've got a business based in your home and you also have a W-2 job, the question is, when you walk out the front door of your home, are you walking out of the door of your home or are you walking out the front door of your business? It's helpful to begin thinking of your home address as a place of business. For example, let's say you live at 123 Main Street. That's where you live and you have a business base there, right? I suggest you start thinking of 123 Main Street as your business headquarters, and you also sleep there. That's a goofy little analogy, but if you use it, you'll start to think about your home address as also a business address. So when you step out of the door of 123 Main Street in the morning to go to your W-2 job, are you leaving a place of business or leaving your home? Well, it depends primarily on what you do before you walk out the door. If you get up early enough to spend a half an hour or 45 minutes or so working your business right before you walk out the door, then you're leaving a place of business to go to another place of business, aren't you? That could convert your commuting miles into business miles. At the end of the day, at 5 o'clock, the bell rings, you go down to your car, and you head back to 123 Main Street. Are you going home or are you going to your place of business? Depends on what you do when you walk in the door. It's the flip side of the same coin. If you walk in and take off your tie and pop a beer and watch the news, you just finished a commute, non-deductible. But if you walk in and do what the natural thing is, which is look at the flashing light on the phone, and you go over and check your voicemail, and then you crank up your computer and you check your emails, and you respond to your business voicemails and business emails, half hour, 45 minutes, now you went from one place of business back to another place of business, didn't you? So it's possible to get these deductions substantial. $3,000, $6,000 easily for most people. Now, here are the record-keeping requirements. I'm going to go through this very quickly. Your record requirements are simply that you don't even have to keep records the entire year. The tax code says that if you keep records for 90 consecutive days, a typical 90 consecutive day period, the IRS will actually let you use those numbers for the full year's numbers. Can you believe that? They're saying that they're allowing you to use that dangerous word, assume. If you keep records for 90 days, which is 1/4 of a year, they will assume, and they will allow you to assume, and they will agree that your mileage for the entire year was 4 times whatever it was during that 90-day period. A typical 90 consecutive day period is what they say. So it doesn't have to start on the first of a calendar quarter. You don't need to wait till April 1st or any calendar, or even beginning of any particular month. You can start tomorrow. Start on an odd day if you need to. 30 days, 60 days, 90 days later, you got your 3-month mileage log, and now you've got your records for the year. What do you have to do during those 90 days? Where do you get a hold of this? How simple this is. People lose this $5,000, $6,000, $7,000 deduction because they think record keeping is too hard. Here's all you've got to do. Every time you start your ignition for 90 days, you're going to write down the answers to 4 simple questions. Today's date, the destination, primary purpose, and number of miles traveled. What day is it? Where am I going? Why am I going there? How far am I driving? That's it. Write those down every time you start your ignition. Now, not just for business trips. If you write it down just when you're using your car for business purpose, you've got to do that all year long. But if you write it down for every use of the vehicle, then you only have to do it for 90 days. Now, why do they want you to write down, fill out a mileage log, a line in your mileage log when you're not using your car for business purposes? Simply because the auditor has to be able to check your math. That's all. So unless they know all the trips you used your vehicle for, then they can't check your math to see that they agree with your business use percentage. Now, when you're filling out your mileage log and you're using it for personal use, you do not need to fill in the parts that's a destination and primary purpose. It's frankly none of the IRS's business whether you're going to church or going to Hooters. It is their business to know you use your vehicle for non-business purposes because that's how they check your math. So I just put a P in there, P for personal. So put P all over your mileage log, and you're going to have a mileage log that will show your business use and your personal use both. Now, at the end of the 90 days, you got a simple math task that's going to take you maybe a couple of hours if you're slow. You're going to add up all the what your starting odometer reading on day 1, your ending odometer reading on day 90. The difference between those two numbers is going to be your the number of miles you traveled during that 30-day period, 90-day period. So let's say that's 4,000 miles. You drove 4,000 miles. So now the IRS will let you take 4,000 times 4, which is 16,000, and now your mileage for the year will be assumed to be 16,000 miles. Okay, now you're going to go back through that log, and you're going to add up just your business use of the vehicle. And let's say that turns out to be 3,000 miles. I'm just random. I'm drawing numbers out of the air that allow me to do mental math. So they're not realistic numbers. You maybe have 92% business use. You may have 62%. It is whatever it is, whatever the numbers turn out to be. If you've got put 4,000 miles in your car and 3,000 were business miles, then you've got a 75% business use percentage. Now you've got two ways of figuring your tax deduction. You can take 55 cents per mile times your business miles, which would be what? 3,000 miles times 4, or 12,000 miles. So 55 cents per mile times 12,000 miles, that gives you a tax deduction of well over $6,000. Or you can take 75% because 3 divided by 4 is 0.75. So 75% of your miles were business miles, so 75% of your actual operating costs can be deducted. And you know what? The great thing is you can figure the math both ways and take the one that's best for you. Now, when you're doing your mileage log, that last column, the number of miles traveled, you've got a couple of ways you can do that. One easy way is to just press your trip recorder to 0, and when you get your destination, write down how many miles you drove. I frankly think that was a little harder than the other option, which is to write down your starting odometer reading. Now, the IRS suggests that if you use the odometer method, you write down your starting and ending odometer reading for each use of your vehicle. And frankly, that's pretty stupid, because if you drove your car from your home to a business meeting, and then you got out of your vehicle, and when you started your engine, you fill out the mileage log. You write down today's date, destination, wherever your business meeting was, primary purpose business meeting, and then you wrote down the number of your odometer reading. When you get to the location, let's say your business meeting at the East Side Holiday Inn, you pull in the parking lot, you turn off your engine, get out of the car. Now, when the meeting's over and you get back in your car, you're going to fill out that mileage log again, right? If you fill out your starting odometer reading for your trip from the Holiday Inn back home, isn't that odometer reading going to be the same? Your starting odometer reading for that trip will be the same as your ending odometer reading from the trip before, right? So there's no need to write down the odometer reading and start and finish. You can write everything down one time. It literally takes me about as long to fill out my mileage log as it does to fasten my seatbelt. It's that easy. The hardest part for me is today's date. Because when you work for yourself and you work 8 days a week and 26 hours a day, you never know what day it is. That's the hardest one for me. But destination and primary purpose and miles traveled, if that's just the odometer reading, I'm just writing that one down. Destination needs to be only as specific as it needs to be for an auditor to say, yeah, that must have been a business trip. And primary purpose, again, you write down, it says primary purpose. So let's go back to our example. We went to the shopping center and bought a birthday present, and we also had flyers made for our business meetings. If your primary purpose was to have flyers made, there is no column that says secondary purpose. So the birthday present never shows up on your mileage log. So this is a very easy, very large tax deduction, and record-keeping requirements are really simple. Let's move into another category that's getting to be rather substantial, and that's healthcare costs. Out-of-pocket healthcare costs didn't used to be really substantial, but it's getting more so now because for two reasons. One is a lot of people now cannot afford healthcare insurance at all. So all healthcare costs are out-of-pocket healthcare costs for them. The other reason it's getting substantial is because health insurance companies have found they can't really raise the premiums much higher, because as they raise the premiums, they lose members. So if they can't raise the premiums, what are they going to do? Well, they could become more efficient, but that's not that's not reality for a health insurance company. So what are they going to do instead? Well, they can't raise your premium. They're not going to get more efficient. So what are they doing? They're taking away some deductions. They're taking things that used to be covered expenses and putting them in the non-covered or excluded category. One of the big ones that I've heard about recently is orthodontics. If you got a kid that needs braces, and by the way, a lot of adults are now getting braces because orthodontists have found a way to make braces virtually invisible. So a lot of adults whose parents couldn't afford braces when they were younger are getting them as adults. Well, orthodontics used to be covered under almost any good health insurance policy. Yet there might have a 6 to 12 month waiting period after you join a new company, but it was always covered. Well, now they're quietly removing some coverages like that. Some insurance companies have now removed that. Well, if you go take your child into an orthodontist and get a routine of braces started, by the time they're finished and the time they talk to their orthodontist the first time until they have their braces removed, you're going to spend at least $3,000 to $5,000, $3,000 to $5,000. If you file a claim with your health insurance company, imagine the shock if you find out that's no longer a covered expense. You say, well, why not? Oh, we dropped that about a year ago. Really, nobody told me. Well, yeah, we don't tell our customers every time we make small changes to our coverages. So now they're claiming things that are not medical necessity or fair game for moving outside the coverage area. Well, let's first look at the definition. Let's see how broad this is. Out-of-pocket health care costs means any expense that is not reimbursed to you by, say, an insurance company. So that would so it's expenses that are not reimbursed, so it's out of pocket, it's out of your pocket. Now, the IRS definition of health care costs is this: it's money spent for goods or services to treat or prevent a condition or illness. Goods would be like prescription drugs. Services would be like a doctor's visit for the purpose of treating or preventing a condition or illness. Now, under that definition, even Band-Aids would be deductible. It's product, it's goods, purchased for the purpose of treating a condition called a cut. Aspirin would be deductible. It's goods purchased for the purpose. Actually, you got choice there. You could say it's purchased for the purpose of treating a condition called a headache or preventing a condition called a heart attack. So even a lot of over-the-counter drugs, even things you buy in the pharmacy section at the grocery store, fall into this category. Now, why do I bring that up? Most taxpayers can claim a deduction for out-of-pocket health care expenses, but they've got, if you don't have a home-based business, you've got two serious problems. One, itemize your tax returns. You've got to file Schedule A. If you don't itemize, if you take the standard deduction, you cannot claim any out-of-pocket health care costs as a tax deduction. Even if you do file Schedule A, you can only claim the amount that's beyond 7.5% of your taxable income. What's that mean in English? It means if you make $50,000 income, and that's what you're reporting on your tax return, the first roughly $3,700 of your out-of-pocket health care costs can't be claimed, period. That's 7.5% of $50,000. You can only claim the amount above and beyond that. But with a home-based business, you can claim 100% of all out-of-pocket costs for the entire family. There's a strategy that's covered under Tax Code Section 105. It's called Section 105 Plan. It's authorized in Section 105, where a home-based business can, by hiring a family member and using a health care benefit, an employee benefit to reimburse health care costs, can cover every penny of out-of-pocket health care costs for the entire family. That includes yourself, your spouse, your kids, everybody in your immediate family, without meeting the 7.5% threshold. That tax deduction in itself is worth at least $3,000 to $5,000. That's just somebody else is paying for all of your health insurance premiums. If you're paying your own health insurance premiums, then you probably got about $1,000 a month that you're paying in health insurance. You got $12,000 in deductions right there. Even for people with at a modest 25% tax bracket, you're going to save about $3,000 to $4,000 just in this one category alone. I want to touch on just maybe one or two more very quickly, and then we'll start to close in on how we get Uncle Sam to pay for all this. Businesses or vacations can almost always become business travel. If you plan correctly in advance, the key is planning it in advance. More than half of your days have to qualify as business days. But what qualifies a business day? Well, your travel days qualify if your primary purpose is business. By the way, primary purpose is what you state it as being. It's not. It has nothing to do with the number of hours you spend on business. So if it's primarily for business purpose, your travel days are deductible. Any pre-scheduled appointment days are deductible. That would include a day that you scheduled even a 30-minute appointment with somebody at a time convenient for you that doesn't affect your family at all. So you could still have all your vacation time and get days qualified as business days by pre-scheduled appointments. If Friday and Monday are business days where you have a business appointment, then Saturday and Sunday become free days. They're sandwiched in. Saturday night stayovers can be free days. If you have a plan that gives you a plane ticket that saves you enough money that is more than the amount you spend in extra hotel fares and food, then the Saturday night stayover can become free time. So $2,000 to $4,000 easily is deductible in this category. So we've talked about just 4 deductions. There are about 10 major deductions. There are over 100 deductions altogether for home business owners. But I believe in the 80-20 rule that 80% of the deductions come from 20% of the tax breaks. So if we look at 10 major tax breaks, that's what's going to put easily an extra $3,000 to $6,000 cash in your pocket. We've looked only at the business use of the home, the business use of your personal vehicles, the out-of-pocket health care costs you can deduct, and vacations becoming business travel. But there's 6 other major categories as well. Now, if we look at the range of deductions that I've estimated that you could save with each of these categories, and total those up, just 4 out of the 10 major tax deduction categories can give you $10,000 to $20,000 in tax deductions. Now, how much of that cash that put in your pocket depends upon your tax category. But let's say you pay 25% in taxes, then that's going to be between $2,500 and $5,000 cash in your pocket from the tax deduction just from these 4 major categories. Now, a word about record keeping. Record keeping is really important because the law requires it. It's not just tax code. It's not just the IRS policy. But the law says you need to prove any deductions that you claim on your tax return. If you don't have the proof, you could lose your deductions in tax court or in an audit. But although the law says you've got to keep records, it doesn't say record keeping has to be difficult. So I have a way that I want to teach you, actually 2 different ways that I want to show you that allow you to keep IRS-compliant tax records that will bulletproof your tax returns in about a minute a day, literally. You spend about a minute a day, 365 days a year, and you're going to have bulletproof tax records if you follow the system that I want to recommend to you. So, okay, we've covered a lot of stuff in the last 45 minutes or so, and so if it seems overwhelming to you, that's normal for 2 reasons. One is all this is new probably to most people on this call. The second is I talk fast because I try to cram about 3 hours, a 3-hour briefing into 45 minutes to an hour, and so I'm talking fast. But trust me, it's not hard to learn this stuff if you take it in bite-sized pieces. It's that old saying, how do you eat an elephant? 1 bite at a time. So if we take this 1 bite at a time, it's not difficult to learn. So what you need to have, I think there are 5 what I call basic essentials for home business tax savings. There are 5 essentials. If you have all 5 of these things, then you're ready to start saving major money on your taxes with a home-based business. The first, you need someone to coach you through it. So somebody just talk you through it like I'm doing right now, only much slower. Talk you through more slowly, let you ask questions, teach you, not just spout all these this information that I'm spouting out tonight. So you need a coach to help you understand it. Not for a long period of time. You can do this in probably 3 or 4 hours worth of coaching, but somebody to help you understand it. You need an authoritative reference that's an easy-to-use guide, something you can look back to after the coaching is done. You say, I want to look back and say, what were those rules again about converting my vacation to business travel? You need a source you can look back to that's easily readable, written in plain English you can look back to. Or something you can go to if your tax pro says, I've never heard of that tax deduction. You want a source you can go back to and show to your tax pro and say, well, see, here's where it says in a tax code it's authorized, and they'll say, oh, yeah, you're right. The third thing you need that I think is a basic essential is updates, immediate updates whenever tax laws change. Tax laws change constantly. You know, last year in 2008, the Congress changed the tax code. There were over 500 changes last year. That's more than 1 a day. Somebody's staying awake nights just dreaming up stuff to change the tax code. We need to give Congress something more important to do than changing the tax code. They did it 500 times last year, so somebody's got to keep you updated. So the third basic essential is to have a source that will keep you updated when tax laws change, so that you always understand what the tax breaks are and you're always compliant with the tax code. Number 4 is I think you need a quick and easy way to keep IRS required records. I mentioned that a minute ago. I've got a couple of ways I'll teach you that you can do in about a minute a day. When people miss out on tax breaks on purpose, it's because they don't want to bother with the records because they think it's too difficult. When people lose tax breaks in an audit, it's almost always the number one reason why people lose tax deductions, why deductions are disallowed in an audit, is because they can't produce the records. Because the IRS auditors know that there's a law that says without proper documentation you get no tax deductions. But if I can show you how to keep records in less time than it takes to say the word documentation, then you'll have IRS compliant records. So if you ever do get audited, you won't have to worry about it because you'll have the records that you need to prove your deductions. And then the last thing is kind of a bonus, but it's a way to an IRS approved method of reconstructing missing records. Because some of you are going to listen to this tonight and you'll say, we're already well into 2009, and I would have qualified for a lot of tax breaks but I didn't keep any records. So what do I do now? Or I qualified for a lot of these things last year or the year before, but I didn't have any records. I've already filed my tax returns. Well, there are IRS-approved ways of reconstructing records. There are approved ways of pulling together your documentation. And there's a very simple method of filing an amended return for prior tax returns. For years, where you've already filed your tax return, you can file an amended return to get an additional tax refund. So these are the 4 basic things I think you need. With these, there's no fluff in here. With these 5 items, you're ready to start saving $4,000, $5,000, $6,000 a year in taxes, putting an extra $100 a week on average cash in your pocket. Someone to coach you, an authoritative reference that's easy to use, immediate updates of changes, quick and easy record keeping, and an IRS-approved way to reconstruct missing records. So here's what I'd like to offer on this call. The Basic Essentials for Home Business Tax Savings is a course that I teach that includes all these things. It's 4 hours of live small group telecoaching. I do it with you live. Only I'll talk about half as fast as I talk now, and there'll be plenty of time for you to ask your individual questions. These are small groups. We generally have between 15 to 20 people at most, sometimes even less than that. So these are small group calls, so you really get all your questions answered. The purpose is to help you really understand all the tax breaks that are available, how to qualify for them, and what kind of records to keep. You'll get a copy of the new 5th edition of Home Business Tax Savings Made Easy because that's the guide. Remember I said a minute ago you need to have an authoritative reference that's easy to use? That's what this is. This will be our guide during this 4 hours of telecoaching. It's an hour a week for 4 weeks is the telecoaching, and you're going to have, when it's over, you've got the guide that to refer back to. Tax law updates for life whenever a tax law changes. First I translate it into English, and then I send you an email with the English version of what just happened and what it means to you, what to do with it. So you can then open up your Home Business Tax Savings Made Easy book and make changes in there. If the standard mileage rate changes for vehicles, you can go to Chapter 8 and open it up and change the mileage rate. So you've always got a current edition of the book. You never have to buy another book from me. I'm not one of those guys that wants you just going to come back every year and say buy the new edition. You can buy it whenever you've got so many scribbles in your current book you can't read them anymore. Until you get to that point, I'll keep it updated for you. I'm going to give you 2 easy record-keeping systems to try out. One of them is a software program that is really is so intuitive that I'm a computer challenged person, and yet I can use this software without a tutorial. And when that happened, I said this is easy. So that's one of the options, or one of the systems that you'll be given to try out. The other one is a paper and pencil system. There are mileage logs, and there are there's like a grid. It sort of looks like an Excel spreadsheet, except it's written, is printed. And when you have an expense, you just write in another right column. And at the end of the month, you just add up the numbers for that month, and you've got your tax deductions for that month. At the end of the year, you add those 12 numbers up in each column, and you've got your deductions for the year. So if you've got let's see, that's 4 of the items. The last one, the bonus, is how to reconstruct missing records. I've done a 60-minute audio briefing for you with an accompanying user's guide. So you're going to get that as part of this package. Everything is downloadable, so you get it immediately. And by the way, I'm going to interrupt myself for a second. If you want to ask questions by email, it's going to be webinarhelp@homebusinesstaxsavings.com. and in the subject line put about the webinar, and don't ask tax questions. Ask questions about the webinar, because we've only got a few minutes left. And I'll answer any questions you've got about the special that we're making. But I won't be able to go into a lot of detailed tax questions. So if I give you all 5 of these things, 4 hours of live telecoaching, the guide, the plain English guide to home business tax savings. It's the subtitle is "The More You Know, the Less You Owe." Tax updates for life, the record-keeping systems, and the bonus on reconstructing records. That is on my website right now. You can buy it for $177. That's a package price, a discount price, $177. But if you want to buy it tonight, I put a special together because I said there are so many people. When I got more than 1,000 people signed up for this webinar, I said I've got to make this affordable to everybody. So it's $97 if you decide to buy it now. Now, I want to say 2 things about that. One is $97 is less than 1 week's worth of tax savings. 1 week's worth of tax savings. And by the way, it's tax deductible also. But it's a week's worth of tax savings. So if you'll invest 1 week's worth of your savings, I'll show you how to put an extra $100 a week cash in your pocket for the rest of your life. Now, this limitation is going to expire at midnight tonight, so it's I'm going to give you. There's a special website on your screen. It's newtaxspecial.com, and that link is going to work until midnight Pacific time tonight. Then it'll disappear. If you go to it after tonight, it won't be there. Then you can just go to the main website, homebusinesstaxsavings.com, and you can get it for $177. But here's the guarantee. Here's what makes this a no-brainer for you. I said I'm going to teach you how to put an extra $100 a week cash on average in your pocket. What if I'm off by 50%? What if it's only $50? Well, by the time you've finished the 4-week course, you've already gotten your money back and doubled it. You're going to save at least $200 by the end of the course. Let's say I'm off by 75%. If you only put $50 or $25 a week in your pocket, you're going to have your money back before the end of the first month, before the course is even over. But here's my guarantee. Look at this guarantee on the screen. After taking the full course, if in your opinion only the information you've learned is not worth multiples of this $97, I'll refund every penny. And you know what? You got up to a year to make that decision. You could decide 6 months from now, I wish I hadn't taken that course back in February or March or April, and I want my money back, and you get it back. Because I've never refused a refund to anybody. I've actually gotten very few refund requests because virtually anybody goes through this course and say, oh, yeah, $97, that was a bargain. I got my money back the first week in that. So I want to make this a no-brainer for you because my intention is not to make a bunch of money on this. My intention is to teach a bunch of people about tax breaks you already qualify for that you may not know about, that nobody's ever told you about before. But once you understand them, once you begin to use them, you'll find that this $5,000 or so additional tax refund, that's every year, starting this year.